Let me share what we got here. So this week, this is a long-awaited one. And every time we do a topic, I really enjoy doing the research. I done bought a home. Multiple times. Several you on the call bought a home. But I enjoy doing the research, quite frankly. And the things that, I came up with, I feel like should be shared. So I hope this really piqued some curiosity here, what we talk about and what I thought I'd bring it forward. Again, I call it 101, basic, simple. You can go down rabbit holes on any topic. So this is about just the basics here to help you understand, the basic framework, the basic steps. There's a lot of steps out there. 3 steps to buying a home, 10 steps. Well, I boiled mine down to 5 steps. So here's our agenda. Okay. It's probably a good idea. We're going to go over, obviously we should be discussing, so what does one do to buy a home? What are those basic steps? We'll cover that. But it's probably good to set the table with, what's the pros and cons? Why do people want to buy a home? What are those wonderful benefits? But I'm always one here. There's pros and cons to everything. There's trade-offs to everything. So I'm always like, let's talk about the negatives too. So we'll tee it up with that, and then just go through those steps. And again, please jump in, ask questions. You got some people who've been through this who can answer a lot of those questions. And then toward the end, always my favorite part, I'm calling it Tales from the Homeowners. And this is ask those questions from these great owners of homes, Cindy Charles on the home, we give it to you real, not that stuff you read in the book on the internet. We tell you what the real is. So we always like to wrap up with that, just really the open discussion. So if you don't have questions as we go through, we'll save it all from there and just have a little round table there. And then we'll do a little Homeowner Jeopardy. So as always, we got to get the disclaimers out of the way. Tracy, compliance officer. Tracy, are you ready?
I'm ready.
Okay, let's have the disclaimers.
I am not a lawyer, tax accountant, or financial advisor. This content and our discussion is not meant to be specific tax, legal, or investment advice. Always do your own research before acting. Seek advice from licensed professionals who can evaluate your specific situation and personal needs. This content is intended only as helpful hints and for educational purposes only. In this meeting, nothing is being sold here.
And I'd like to remind everybody again, while we do this, our meeting is about educating yourself in a safe space with like-minded people who share the common financial goals of building wealth and leaving a legacy. Okay, so the formalities out of the way, let's get into it. Now, I thought it would be a good idea, even before we start talking about, how do you even buy a home, and just generally, what do people view as those pros and cons? Let's talk about the good and bad and ugly a little bit. I'm gonna start on the pro side, right? So I call it intrinsic value. That's like your happiness and your freedom. Some people just feel a great sense of satisfaction knowing this is mine. I work for it. I'm a big boy, big girl. This is all ours. That's real. You really feel that way. You don't have a landlord. So that's like the intrinsic value. You really can't put a dollar number on that. That's one of the big reasons why people first want to get their home. Then appreciation and equity. We're definitely going to talk about that more. There are a lot of financial benefits to home ownership. This was like a big secret to me until we bought our first home. All the benefits. And many of them are really incredible. And that's why a lot of people, along with just want to have your own home, your own space, that's one reason why a lot of people get into it. Because of those financial benefits, it's going to accelerate your path to financial independence. And that's what our whole little mastermind group is about, getting to financial independence, building wealth, leaving wealth for our kids and future generations. When you start to see how home ownership works, the tax benefits, appreciation, equity you build, you start to understand why so many people own homes, invest in real estate, and why that's like a central part of most people's financial plan and their net worth. Again, there are so many tax savings. When you it's almost unfair. When I just found out all the different tax savings with owning a home versus being a renter, I'm like, this is unfair. The whole country is run on the backs of single people who rent. They pay all the doggone taxes. So that's one of the big benefits of owning a home that everybody likes. And now I don't hear a lot of people talk about this, but I talk about this all the time when I'm talking about real estate and the benefits of it. I call it utility of home ownership. We'll discuss that later if you're interested. But along with all these other benefits, there's a utility to home ownership. I mean, you can do things when you're a homeowner that you can't do when you're a renter. You can, I'm not going to go into it now. There's a list. We can touch upon it later, but you can rent it out. You can you can rent rooms. You can rent your garage. There's so many things you can do when you own your own home. When you own your home, it's gonna as long as you're paying timely, it's definitely going to increase your credit score. There's no doubt about that. So that's like a side fringe benefit that's happening automatically, where you're not don't get that benefit necessarily when you're paying rent, because they don't report that to the agency. You have more control over your monthly housing budget. So you're out there, you're renting, you're owning a home. The rent is the rent, and that's the number, and usually it's going up every year. This kind of goes to the utility of home ownership. You can like refinance your mortgage and lower your monthly payment. So that's like one of the options when you own your home. And people do that all the time. We're in a rising rate environment right now, but when those rates start coming back down, you'll be hearing your co-workers and people who own homes, oh, the rate has dropped 0.5% or 1%. I'm looking to refinance. They're looking to get their payment lower. And when they refinance, they can actually take money, cash, hard money out of their house and put in their bank and have a lower payment, right? So we're not going into all that today, but this is just telling you these are some of the wonderful benefits of owning a home. And then, I threw this out there. I want to say more clout and respect. And I was debating, should I put that? I don't want that to rub anybody the wrong way. What do I mean by that? You know what I found out? And again, I don't paint this world. I don't make it. But I found out that people, politicians and stuff, when you're calling city offices, government, everything, I found out that they respect you more when you tell them you're a homeowner in town and you pay taxes and stuff like that. I found out it's like, it shouldn't be that way, but unfortunately it is. So again, that's what I've seen. But as I said, we always got to talk, there's good and bad to everything, right? What's some of the cons? There is no landlord. Something breaks, you got to fix it. I remember when we first got our house, I don't know what went wrong. The furnace wasn't working. We're like, who we supposed to call? Your daddy, Tracy? Because I don't know nothing about furnaces. Who did you call? Oh, that's on you. You got to figure it out. But we're talking about how you have this approach to everything. But you're responsible for that. And some people like that. Some people just like, look, I could just make call to the landlord. It's all taken care of. With a homeowner, you the landlord. When you first getting a home, there's a lot of upfront costs when you're buying a home. We'll talk about that more lately. So you got to shut out a little bit, when you're buying, when you first move in, you do have that. It's hard to get around that. And when you own a home, you pay property taxes, right? And so that's a never-ending battle too, because every year property taxes go up and your insurance can go up, right? So that can raise your payment. A lot of people don't talk about that. So that's one of the cons. Owning a home, it always requires upkeep and maintenance. I mean, you hear a lot of people say it's like having a baby. It's just always something, That's the unattractive, unpleasant part that everybody don't tell you. In the beginning, if it's new or if you're buying an existing home that was well cared for a few years, you're good. But I'm telling you, man, even with a new home, after about that 5th year or so, it's just a constant. You'd be amazed at how much we plan around. Oh, we got to get a roof. Oh, we need to paint. Oh, this needs to be done. Oh, the landscaping. Oh, so it requires maintenance. You just don't buy a house and move in. Anything man-made requires maintenance and upkeep, fix up and repair. Obviously, there's less flexibility. It's much harder to just pick up and move. You're renting, you think you might be moving to North Carolina in a couple years. That works great for renters, but when you delayed your roots somewhere by becoming a homeowner, it's much harder to just pick up and go because you just can't sell a house tomorrow. It takes a long time to buy and it takes a long time to sell. So they usually say, and some people say 3 to 5 years. If you plan on being in a place in a town 3 to 5 years or more, you could consider buy. I say 5 to 7, but anything less than that, you don't even want to consider buying a home. It's just too much trouble, the cost and all of that. So I think I mentioned this is always maintenance, fix up and repair. Always, 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 always. You as a homeowner, it's just a lot of responsibility with being a homeowner. No biggie. A lot of people feel a great sense of satisfaction about that. But again, you responsible for a lot more than I can list here. So this one where you got to look at, again, a lot of people look at their home as their kid, their baby. You got to take care of it. You're responsible for a lot. And then, with a home, obviously you pay all your utilities. You could be renting and you just pay for electric, or you just pay for electric and water, just water. Ain't none of that when you own, you paying for everything. And that number could be substantial, particularly if you're moving from up to, much more square footage than you used to live in when you were renting. So that's just some of the pros and cons there, as I see it, just to tee it up, why people like it, why people don't like it. So let's just talk about how do you buy a house? I boiled it down to 5 steps to home ownership. This is good for first-time homeowners or somebody who hasn't been in the market for a while, just to refresh your memory. I'm probably the only one who would say there's a prerequisite to everything. Begin educating yourself. This is it. You just wouldn't go out and start shopping. Educate yourself a little bit about the process, what you got to do, what the laws, what the rules are. Know your rights. So I would always start with that if this is something you're serious about, as a future goal. And like I say, this is a part of that process. So the steps, I'll read them out here, but we're going to go into each one of these. One, you want to determine how much house you can afford. Give you examples of what that might look like. You're going to need to shop for a loan. Most houses today, I don't know what the average price, I don't have that handy for a home in the US. Probably $250, $300 or more. I don't know what a lot of people pay. Most people just don't have that sitting in a bank account where they could just write a check. 90% of people buying a house, they're getting a loan from a bank or a mortgage company. So you got to shop for a loan. That's a process. It's the way you go about that.
Hey, Brian, I was just looking at a program. The average house today, most people, is about $400,000.
Yeah. Now, don't let that run you off, new home buyer. We're gonna talk about how you get that done. So we're gonna actually look at some numbers in this. But yeah, and so you need a loan to do that in most instances. So you get that loan, and you get what's called pre-approved for the loan. It's not the actual loan, but it's a pre-approval, where it's where your lender is saying, okay, I've did a preliminary check of all your financial information. We think we can give you a loan for whatever, $300,000, $400,000. And so people usually, when they're serious, they usually will get that pre-approval, and then they go looking for a house, which is step 3. And that's usually when you're working with a realtor and that sort of thing. And quite honestly, a realtor, if you're saying I want to buy a house and you're calling a realtor, they might talk to you a little bit. They might send you a few things on the internet. But the more you engage them, they're going to, at that stage, step 3, they're going to expect you to be pre-approved. That lets the world know that you're serious about buying a house. You've turned in financial information. You're working with a lender. So that's kind of prerequisite, get pre-approval to step 3. Although you obviously could do looking on your own. You can be on the internet. There's virtual tours and that sort of thing. And then so we'll talk about that. And then you find what you like and you make an offer, right? And, there are a lot of provisions, kind of legality to home buying. Offers got to be made a certain way, their forms and everything. So I like to tell people, buying a house, it's not complicated, but there are a lot of steps and there's a lot of paperwork and it can be a little bit stressful, right? So, but if a good realtor, a good real estate agent is important for this. I'll repeat that over and over and over. Everything I'm showing here, when you're working with a good agent, they're going to guide you through all of this. They're going to make sure you're checking all the boxes, doing everything right. So, and then the final thing, once you made offers, the offer's accepted, you negotiated back and forth, offers accepted, you have what's called a closing or a settlement. So you hear people say, go to close, you go to close. And that's where there's just tons and tons of paper, mounds of paper. Your wrist is you're going to get a cramp in it from signing all the different things you have to sign. So you and the seller are there, or their lawyer, or your lawyer, whatever, or both. And there's a closing agent, which is sort of like the middle person. And they make sure everything is signed, everybody's doing the right thing. You got to bring money for closing, right? But that's the final step. And once that's done, you get the keys and you're a homeowner. So those are the basic steps there. And then we'll finish up, like I said, with Tales from the Homeowners. I'm looking forward to it. So a little bit more about, let's start with the prerequisites. I'd say you should make sure you're educating yourself and knowing your rights. Now, I always like I take the liberty to slap these slides together. Uncle B here is going to put my spin on it, my preference. You should be debt free if you're looking to buy a house. You should be debt free. I mean, I'm giving you my years of experience, what I've done, and knowing people who've done it. I highly recommend that. If you're not, you are building trouble for yourself. You need an emergency fund. Definitely, because of what we talked about, all that fix up and repair. Something's going to happen. You need to be able to take care of things right away. You cannot be without your furnace on the coldest day of the year in December with no way to repair it, or your hot water tank goes out on the coldest day of the year. Cindy, I remember we had I think it was the Christmas dinner at Aunt Hazel's, and our hot water tank went out, y'all. It was that coldest day of the year, and that called us. We had to boil water, dump it in bathtub. How many days did we have to do that? If I'm just unprepared, it wouldn't take that long now because I know what to do, but just unprepared, not knowing what to do. I don't know how to put in no hot water tank, and where do I go? Who do I call? How much does it cost? When can they come? And as we said before, if you should expect to be there. I say 5 to 7 years. Some people say 3 to 5. I'll say 5 to 7. You don't think you're going to be in a place 5 to 7 years? I wouldn't even be considering this. About knowing your rights, like I said, there's a lot of legalese, a lot of stuff, Fair Housing Act, Real Estate Settlement Procedure will explain all that. It gives you an idea what goes on, what your rights are, because you experience a lot of discrimination, not just from sellers, but from the banks, from this, that, and the other. You need to know your rights. So there's some documents out there. And again, this stuff, when you're working with a realtor by law, the purchase and selling of the house is so regulated that, by law in most states, they're required to give you these things. They will explain this stuff to you. So I would call those sort of the prerequisites to getting this journey started. So step one, determine how much house you can afford. So obviously this is the big one. What's your price range? Can I afford a $400,000 house or a $200,000 house? You should get out, and I would say, I say determine, but I would say get an idea. Because once you bring that agent into the picture and your banker who will provide the loan, they're going to help narrow that down. But you're probably like, okay, I want to get a house. What can I afford? I don't know. So you need to determine that price range. You'll need a down payment. You definitely need a down payment. Again, unless you got it like that. Unless you got thousands of dollars on the side that you're ready to put on the down payment. And maybe, if somebody's been working on this, maybe they've been saving. Sometimes people save for 2 or 3 years to get the down payment they know they need. Then they get going. But typically, everybody needs a down payment. Or you at least need to know where that money comes from. You have investments or some sort of savings, you're going to need to know where it comes from. And again, they're meticulous, and the bankers and everybody about document. This has to be well documented. Where's your down payment coming from? Oh, you have $5,000 in this account, and you're going to take this amount of money from this account, and you're going to say you got to show proof of where these funds are coming from. Like, so just expect that when you get to it. Point is, you're going to need a down payment. And typically, the minimum down payment is about 3.5% is what you will find. FHA, and we'll talk a little bit more about FHA, you can get by with a little bit less, but most retail purchases are done with most bankers are going to tell you you're going to need at least 3.5%, sometimes more. And the way it works is the more you could put down, most people say, try to put down as much as you can. The more you can put down, that typically will lower your interest rate, which will make your monthly payment less. And there's insurances you have to pay. The more you could put down, the less you have to pay on those insurances. So that'll make your payment less. And so just generally, you hear that advice. Put as much down as you can, but the minimum is typically around 3.5%. So I just want to make sure everybody's catching that. It's 3.5% on $100,000 is what? 3,500? Am I doing that math right? Mm-hmm. So 200 is 7,000. On 300 is what? 10,000. So you can see these numbers, that's on the minimum, 3.5. You want to put more, it can get up there. When it comes to knowing how much you can afford, it's the price of the house, right? Because that's going to determine what your payment is, how much you have to put down. And then it's also, once you got an idea about that, you can begin to estimate what your monthly payment will be, right? And when we talk about monthly payment, let me get my pointer out here. When we talk about monthly payment here, you will hear this term PITI. And so that's your what we call the complete payment, or your payment includes everything. That's principal and interest and taxes and insurance. Typically, the mortgaging company will include all of that in your monthly payment. And so a lot of times people will ask you, when they're asking your payment, you give them a number, they will say, is that principal and interest only? Or does it include taxes and insurance? Is that PITI or is that just PI? So this you're going to quickly learn this little phrase quickly once you get into it. But oftentimes your mortgage payment will include all these four things and more. It can also include something called PMI, which we'll talk about later. But PITI, principal, interest, taxes, and insurance. So, I mean, that's the meat of it. I mean, you know, when you look at your monthly payment, if you're moving from being a renter to being a homeowner, I mean, that's what it boils down to. You're looking at how much am I paying in rent now? Okay, how much house can I get for that same amount that I'm already paying in rent? That's what a lot of people begin to look at. 2836 rule, again, this is related to how much you can afford. Most lenders look at this rule. They got these guidelines. One of the more popular ones, 2836. They'll look at all your financial stuff and they'll say, okay, how does this work again? They'll say your housing payment, like say your payment was $2,000 a month. That $2,000 cannot be more than 28% of your monthly gross income. That's the max they'll accept. And it cannot be, then once you add that plus your other debt, if you got credit cards, if you got a car note, they'll add that together. And then they'll say that combined amount cannot be more than 36%. All your debt with the housing payment cannot be more than 36% income. So this is a rule of thumb that most lenders have. And they got other little rules like this. And so you'll get to know that. You'll be hearing them mention that. They'll be looking at that when they're looking at your financials. Now, Uncle B's 25% rule. Let me break it down. This is my rule. This is my record. If you asking me, ain't nobody asking me, but if you asking me, which is very close to the 20% rule, I'll say have a 25% rule. And the 25%, and more people are saying this to 25%. Your payment should not be more than 25% of your take-home pay. And to do that quickly in your head, if you're getting paid twice a month, that's half of one of your checks. And simple. And again, these are just guidelines. If it's 25.4, 26, It's just these are the comfort, secure areas. Remember, these loans are typically 30-year loans. And over that time, people get in trouble with them. What if you lose your job? This is why I say you need to have your no debt, an emergency fund, stay within, I like the 25% rule, so you can weather those storms. The storms are going to come. That's what I learned in life. The storms are invariably going to come. Me and Tracy's been through them. Most people I know have been through them at some point. Okay. It's just, are you prepared? Do you know how to handle it? Or have you been irresponsible? And your housing payment is 50% of your take-home pay. You're headed for a foreclosure. So I would highly heed the advice here. So that's determining how much house you can afford. A little bit more on this. Here's a good example. I like to always look at real live numbers. Let's look out over here to the right. Here's an example. If the price was $200,000 for the house you want to buy, and this 7.419 is the prevailing rate here in Illinois, our last check. Interest rates have been going up. You guys hear that in the news with the Fed and all that. So this is where we're at. It's getting pretty pricey, which is going to increase the cost of a house. And then if you put that 3.5% down, remember I said typically you're going to have to put at least 3.5% down. So let's assume you put down the minimum. Your monthly payment on that would be $1,764. And that's the PITI. It includes all that other stuff. If you look at the $300,000 number here, same terms, fixed rate loan of 7.4, you put your 3.5% down, you're going to be at $2,646. So you can see as you go up $100,000, it's almost another $1,000 in price, $900. And here I took this $300,000 just so you can see close up how it's broken down. The principal and interest, you always have that. If you have a car loan, you're paying back principal and interest, right? But with a house, they're going to put property taxes in. Now, this could swing wildly, right? Because property taxes depend on what state you live in, what county you live in, right? But I just use a sample of, I think, about $5,000 a year on the taxes. Home insurance, about $1,000 a year. So they break it down monthly. I'm going to introduce this term here, PMI. PMI is private mortgage insurance. So back in the day when you would buy a house, you always had to put 20% down. Now imagine having to put 20% down on a $300,000 house. That's $60,000. So over the years, we have all these different types of loan programs. Again, they got it down to 3.5%. But still that 20% number is important because what PMI is if you're not putting down 20%, that 20% number, you're required to pay PMI insurance, private mortgage insurance, to the lender every month. Okay, so you see that gets added onto your payment. Over time, you're going to build up equity, paying down a loan, and the house will appreciate. So that's your equity, and we're going to look at that a little more in depth. So you're going to get to that 20% mark at some point, some year in the future from loan pay down and appreciation. Once you get to 20% equity, this PMI just drop off. And see, that's what I mean. This is one of the things that your mortgage payment can just get lowered by stuff like that. Okay. We're dealing with a 7.419% interest rate, right? This is the highest it's been in years. It's been going up and up. But in 4 or 5 years, rates are going to be going down. Rates used to be like 3.5%. I'm not going to go to the calculator now in the interest of time. But if the rate in 4 or 5 years, if it dropped to 3.5%, you could refinance, and that's going to bring this payment way down. And you're going to be like, man, that's free money. But see, those are some of the things you could do when you own a home. You could control it and manage it that way. But this is just an example of how a housing payment gets broken down. Any questions or thought there before we move on? Okay. So we're on to step 2, right? So we got an idea how much you can afford, price of the house, how much you think you can afford monthly payment, down payment. Now it's time to kind of like shop for a loan. So what I'm going to tell you about this is all different type of loans. Again, you will learn it in the process. This is Homeownership 101. Just let you know that there's different loans out there. I know everybody's heard of FHA. from the Federal Housing Administration Authority, VA. Their fixed rate loan, adjustable loan, interest only, jumbo. Just for example, you can have, in that example, those were fixed rate loans. What are fixed rate loans, right? Your interest rate is 7.4 for 30 years, and it's 7.4, it never changes. But some people get an adjustable rate, where if the prevailing rate is 7.4, they'll get an adjustable rate loan where the rate is lower, 6.4, or maybe 5.4 lower. And if you don't know, for the uninitiated, you might, okay, that's win-win. Why wouldn't I do that? Well, the reason why you don't do that, because they adjust up over time. So like it may be that lower rate in the first year or two. So your overall payment is lower, but each year it's going to adjust up. They put a cap on it, like it can't go up more than 5%. There's an unlimited types of adjustable rate loans. But again, this is why I said earlier, I said again, that I only recommend fixed rate loans. There's just some things this is family and friends. Y'all want to know what I think, I'm telling you, only get a fixed rate loan, guys. Interest only, that's another one these are the type of loans that sent a lot of people in foreclosure, made a lot of people lose their home. A jumbo loan is like they amortize it over 30 years, like the example I showed you there. But they say in 7 years, the whole loan is due. That's called a jumbo loan, right? And you might think, well, why would somebody do that? Well, they do that because one, for these first 7 years, the rate can be a little bit lower, right? It could be a little bit lower, so they got a little bit less payment. And what they might do is, what they're saying is, 7 years. Well, I'm gonna sell in 3 years, so give me that lower rate now. I'm gonna be gone in 3 years. But I'm just telling you, life happens and those well-laid plans never come to fruition, and then people are in trouble. I tell people all the time, just only get fixed rate loans. Just give, and then right now, we also said what the interest rate has been going up over the past year and a half. It was at 3%, now we're up to 7%. So your payment, those people who were in at 7%, and if their payment adjusted for any reason, their payment is going up like crazy. And I've watched these people and watched the news and everything. I've been doing this for a while, and I've closed on many. I know what's happening, and so I had to learn this. If you were a fixed rate loan, the fact that Jerome Powell is raising the interest rate at the Fed don't affect you no iota. That's everybody else yelling and freaking out there. So again, you see it here, Uncle B's opinion. That's what I'm labeling it. Only do fixed rate loans. I mean, again, there could be some expert, very experienced people looking at this post, this presentation later on this call. I hope people share it around when we get it posted up. I hope, it helps somebody, as well as the people on this call. And, some experienced people can look at it and say, oh, this is how you use this. Is how, with 99% of people, if you were expert investor, you do all this tricky stuff, you real disciplined, sure. To me, that's 1 in 1,000 people. The rest of us should never be bothering with those type of loan terms. And then pick a lender. You got to pick a lender to work with at this phase when you're shopping for a loan. Typically, loans, people get them from a broker or a bank. A bank is like you go into whatever, Bank of America, Chase Bank, and they have their own loan products. A mortgage broker is someone who's not captive to just one bank. They will get the best loan by offering loans from all different type of banks. You typically are going to get a better loan terms from a broker because they can shop all the banks, right? So that's the difference. Mm-hmm. So when you go to them and you start working with a broker or a bank, whatever, you're going to give them all this. You're going to discuss all this. They're going to break all of this down way farther than I can. They train and know and license and all of this. And they're going to be moving to, getting you pre-approved. So when you get pre-approved, and pre-approval could be an actual letter. Because, when you go out to shop for a home, you want to buy something, you approach a buyer. Some buyers will say they want to see proof of funds. They want to know your proof because a lot of people waste their time. Hey, how much would you take? You got listed for $300. When you take $280, they ain't got no loan to prove. So they'd be like, you got to show me proof of funds. And banks and mortgage brokers will give you that if you need that. So that's what pre-approval, like I say, even realtors, they're going to be hesitant to keep going with you if you haven't gotten pre-approved. They're like, you're not serious. You're just wasting my time running me around. So that's an important step. Shopping for a loan. We talked about loan types a little bit, but there's a couple of things I want to point out. So most banks will require a credit score of 620. That's your target. Most banks are going to want you at least have a credit score of 620. Again, you want it to be as high as you can, because the higher your score, the lower your interest rate on a loan, which translates to a lower payment, right? But most banks are going to target 620. With FHA loans, they will let you go a little bit lower. I've seen 500. Now, that's not always advisable, because what they would do is they said, okay, we'll take a 500 score to give you an FHA loan. Well, instead of 3.5% down, you got to put 10% down, right? So it's like I said, everything in life is a trade-off, but you will see that sometimes. Typically, it's 620. FHA and VA loan, a lot of people get those loans. I think I've had those loans 80 or 90% of the time. You, as the borrower who needs the loan to buy a house, those are usually the best loans for you. And there's more control. And so you're not messed over and rules and laws. Banks don't always like it because there's more paperwork for them. And they want you to do what's called a conventional loan. You just come to the bank, you're not as protected as much. If it's a FHA loan, banks have a harder time just messing you over. You can get in with a lower credit score. You can get in with a lower amount down. So same thing with VA. With VA, if you're a veteran, VA Veterans Administration loan, those are popular. There's millions of those loans done throughout the year. You can actually get those with no money down. These are benefits to our veterans. And then there's the USDA again. Those are for loans in like rural areas or areas where they're trying to revitalize in the city, right? Those type of areas. Again, you can get LTV as loan to value, which means you're putting no money down. They're going to finance 100% of the loan to value, but you can get lower rates. And even though you're not putting money down, you have to pay PMI. That PMI amount could be less. PMI is typically $75 as a rule of thumb, $75 per every $100,000 borrowed. Okay, so if you're buying a $200,000 house, that's $150. What is that? $225 on a $300,000 house, $225. So that's add money to your payment. Right. And so we talked about that. Anytime you put less than 20% down, you're going to have PMI added to your payment, private mortgage insurance. So PMI, what is PMI? That's what we just talked about. And by the way, it protects the lender, not you. Again, this is, we all homeowners go through this stuff. We never know what this stuff means. I mean, I lived in my house forever until I realized, okay, private mortgage insurance. Why does that not pay if I can't pay my mortgage? It ain't for you, it's for the bank. If you can't pay your mortgage, it protects the bank, not you, And so we talked about his additive is 20% down. Okay, I said I didn't look ahead, but it's in my brain. We talked about all of that. So there's just different type of loan types. One last thing on the loans, there's a lot of loan programs out here. Now, I did not take advantage of this. I always forgotten about this. There is a lot of loan programs, first-time buyers or homeowner programs. They're typically run through the bank. So when you go into your mortgage lender stuff, ask about these. Ask your realtor, ask your broker. You guys would be amazed. There are tons of them. So usually the money comes from the federal government. They give it to the states give it to the county, cities and stuff. But they'll things like $5,000 down payment assistance. We lower your interest rate by 1 percentage point for the first 10 years. There are incredible programs out there where they're trying to make the cost of home ownership more affordable. And why they do this is because, again, right or wrong, it's commonly believed that homeowners make for a more stable neighborhood and community. They want people to own homes. You have more pride in ownership. When you have something on the line, you own a home. So it's a lot of incentive there. This is like one example. There's a ton of them. I just thought I would give you guys this one example of these mind-blowing programs. This one is called the First-Time Home Buyer Program. Okay. It's from HUD, Housing and Urban Development. That's HUD. It's called the Good Neighbor Next Door program. This is for law enforcement, teachers, those public officials, firefighters, emergency medical people. They want them to live in a community, where they work, these type of people. And this thing gives you a 50% discount off the price of the home. Imagine that, y'all. Imagine that if you can get one of the program. And what they do is, let's say you got a $400,000 house. They give you 2 loans. The first loan is for $200,000. So it's like you're paying on that $200,000 loan for a $400,000 house. They give you a second loan for the other $200,000. But what they do is, as long as you stay compliant within the program, you're living in the area, you're doing what you're supposed to do, they tell you don't have to pay on the second one. And after whatever it is, 33 years, 5 years, 10 years, I don't know wherever it is, they just forgive that other $200,000. So you basically buy a house for half the price. Wow. Imagine that. Wow. And it's just one example. There's just tons of programs out there like that. Ask about those programs when you get to the point where you're starting your journey. All right, we're on to step 3. We're getting closer. Got the loan, right? So let's go. You figured out how much you can buy, and you got the loan. So now it's time to go house hunting. Oh, okay. We got a question. Question on this. Hold on. How do I see? Melissa, Donna, you want to get in there? Or did you put
me, Uncle B.
Okay.
Question. If before we move on from loans, what type of loan, or would you get a loan, I guess, or what type of loan would you need if you bought a HUD home and you wanted to finance like the home and then later the renovations, or can you do that?
Yeah. So, and again, nobody's on here an expert or mortgage broker. I'm just going to tell you what I know. And if anybody else knows more, please chime in. There are like loans just for that. I forget I think they call 203B. I may be totally wrong. But they're loans where you want to buy a house. What they would do, they would finance the cost of the house plus the repairs in the one loan, right? So they're programs just for situations like that. I'm sure there are other programs I wouldn't even know about. Again, my advice, I would just ask about those. But I've heard of that loan before. I think it's called 203 something B, where you finance the price and the repair and fix up in the loan, in the one loan.
Okay, thank you.
Yeah. Don't quote me, guys. Always follow up on those things. But it's just so much available. Okay, so your money is good. You know how much you can afford. You got the down payment, or you can save for it. And by the way, a lot of people, they say, okay, I'm going to buy a home. If you just decide today, I'm going to buy a home, you at least 6 to 9 months away at a minimum. At a minimum. It takes a long time. So a lot of times when you're making up your mind, part of it is I'm going to start saving that down payment while I'm doing all this other stuff you're seeing here. That's what people do, putting the money together. But this is the fun part. You go house hunting. Now, I recommend I wouldn't go alone on this. I wouldn't go this alone. I would get an experienced real estate agent. I know a lot of us have friends. Y'all know how I feel about the Pookies and Ray Rays and the cousin Pookie. I feel like this is a big, big, big purchase. I would really advise you work with an experienced agent on this. Again, everything I'm telling you, a question like what Melissa just asked, stuff like that, they are going to fill in the blanks. They're going to make sure everything is checked marked. They're going to be able to answer this, bring in the right professionals, resources to make sure you're getting the right option. They're just going to help you find the house of your need. They will know the area. They will know the prices in the area. I just wouldn't do that alone or do that with an inexperienced. I mean, they got all type of for sale by owner sites and stuff like that. Unless you're experienced already in buying homes and navigating and that sort of thing, then you can do that. I did a lot of real estate investing. I mean, I've done this working directly with the homeowner and putting together the contract, and I researched and did all that back in my day when I was active in that, right? A retail investor, I wouldn't advise that. The realtor is also they're going to help you assess it. They're going to help negotiate on the contract, make offers and counter offers for you. They're just a wealth of info. They typically will charge 5 to 6% on a commission. That's what you should know. That's based on the price of the house, right? Again, this is just pay to play. Everybody, people don't work for free, right? Everybody getting their share, extracting their pound of flesh. The mortgage broker, the lawyer that's looking over it, the inspector, everybody, so folk don't work for free now. But a good agent will save you thousands of dollars. You would think that little 5-6% ain't nothing. So that's what I recommend. And when you really ready to say, I'm okay, I did all that preliminary stuff, I'm looking for a house now, you should be working with a good experienced agent at that stage. They'll be sending you stuff. They're just invaluable. Sending you houses, making sure you're paying the right price. They would show you what the market value in neighborhoods. Tell you they'll know about the parts of town, what neighborhoods had the good schools. That's their job to know that stuff. Okay, and then you want to begin identifying your preferences. When in this house hunting, you got some decisions to make. What are your preferences for a new home, right? What are your preferences? A lot of people, this is just some of the stuff that people consider, right? What's the tax rate? Remember, this is based on the county you live in. My taxes are through the roof in the county I live in. A lot of people just won't live here because of the tax. That's why a lot of people move from the Midwest and the East down south later in life. Their property taxes are so much cheaper. I mean, that's real money. It's amazing. Do you want a single family detached home, or you want to live in a condo where you have common areas, or a townhouse? What's your preference? You want 4-bedroom, 3-bedroom, 2-bedroom? How many babs you want? 3 or 2? You want attached garage or detached garage? What about the neighborhood? Are schools important to you? Do you have school-age kids? And the better the schools, the higher your taxes are going to be. That's a big part of what comes out of property taxes. They go to the schools. You want a basement? Is that important? Fenced yard, maybe. You got a dog. You're going to get one. You want it to be walkable, or you don't care about that? You're a driver. You're going to be driving everywhere. This is going to be sorted out. And trust me, your realtor is going to be trying to help you whittle this down. I got to know your preferences. What am I looking for you? So, but that's the fun part. This is the fun part. So finally, now we need to make an offer. You're going to make an offer. You found the house, got your preference. You found the house. You're like, this one right here, realtor. I want to make an offer on that house. So, don't worry. Your agent's going to work with you on this, right? How that's done. As I mentioned before, there are a lot of legal E's involved in buying a home, right? A lot of I's that have to be crossed, T's that have to be crossed, and I's that have to be dotted. A lot of legality that you have to follow by law, and they're gonna help navigate that for you, right? So you don't have to know all of that. You're not going that alone. That's what they're there for. They're sure your offer is valid on the purchase agreement. There's specific provisions that need to be made in the purchase agreement, right? And then they will submit that and do work with any counter offers, report back to you, and that sort of thing. So they're really useful for stuff like that. Once your offer is accepted, right away you're gonna have to get a home inspection. And so you looked at it yourself. You looked at it and by the way, I know we do all this virtual tour stuff today. I couldn't buy a house like that. I got to go in there and look at the house myself. I don't know why y'all there. I know everything is virtual today, but anyway, you're gonna have to have a home inspection anyway. And like I said, these things are mandated. The bank, the mortgage company, they're not gonna be giving you a loan unless you can see an inspection report. You got to have an appraisal. An appraisal is a formal thing. The realtor can give you a market analysis, but an appraisal is very formal. And these things cost money. So you have a home inspector and appraiser coming there. So that's after, and if they come back like, yeah, I know it looked fine when you were looking at it, but this roof got a leak. And see, this is what a lot of people negotiate on. They'd be like, okay, homeowner, are you going to fix that roof? You going to give me $10,000 off the price? Because now I got to fix a roof because they're not going to close on my house, that sort of thing. The appraisal is important because what's that doing? That's credit checking you. You think you're buying a $300,000 house. Well, after that appraisal came in, it came in at $250,000. And so the bank ain't gonna give you, that, $300,000 loan on something that's appraised at undervalued or something like that. So those are important. That happens after your offer is accepted. And there's some other stuff, and I put it all here, but that's those are the big ones. And before you can get that loan, you got to put an insurance policy on it. That's going to be required as well, right? So you have all this, like I say, not complicated, but it is a lot of steps and a lot of paperwork, y'all. So finally, you're at the closing, right? Congratulations, you made it. This is the big day, right? You will you go to the closing, what's called the settlement. You go to the settlement table. We were talking about that earlier. I mean, that meeting can be anywhere from 2 to 4 hours, and it's mounds and mounds of documents, particularly if it's an FHA or VA loan or something like that. Again, which I said, very beneficial to you, but much more paperwork, So, and this is where the title was transferred. You have to bring money. They'll let you know beforehand what the closing costs will be. It's typically 3 to 5% of the housing, the price of the house, typically. And they'll let you know typically like three days before, hey, you estimate you're going to need to bring this much to closing. They usually want you to bring it in a certified check. It's very formal, all this stuff. And the closing agent is the one that's playing the referee. And so it's a process. You're going to have a cramp in your arm, signing all that stuff. It can take 2 to 4 hours. But once you're done, those keys are handed to you. Now you're a new homeowner, hoping to never go back there again. By the way, I didn't put this in here, but I was thinking about this. When you close on, make sure you're going to be given a copy of documents. And one is a settlement statement, it's called. And then there's just copies of all other documents. Make sure you save that stuff for life, right? You're going to need them for your taxes, that settlement statement, right? So that's going to be your going away present along with your keys. You retain that stuff, particularly the settlement statement. You need that to do your taxes. And I've been told, always hold on to that in case someone has to go back for any reason. So just a pro tip there. So that's the final step. Now, we're at my favorite part here in the presentation is some of the takeaways, tales from the homeowners. And this is where I want to hear from you homeowners, Greg and Cynthia and Charles, whoever else. But first, I made this list to get it going. And I want you guys to weigh in with questions and ask more about this. I'm just going to look at this list. I'm just going to pick out a few of them. I'm not going to read all this. This is what the real is like. So a couple of things here. When something breaks, we already talked about this. Can't call the landlord. You're the landlord. I would advise you learn to fix stuff. I tell people, learn to fix stuff. And you learn this over time. You would think I was a certified HVAC, the way I can take apart a furnace and fix stuff and put it back together. You'd be shocked at how I've learned some of this stuff over the years. And a lot of that learning came from watching somebody who I had to pay come out and fix it and explain to me what they were doing. That's how you learn a lot of it. But there is a thing called YouTube these days. Y'all might have heard of it. I advise that you use that. That would really help you. So these repairs and stuff, my point is, you'd be well served to slowly learn how to take care as much of this as you can. And then there's many services like Angie's List. With technician stuff, I rely on Angie's List a lot today when I do got to get a service technician. I think I'm going to talk about number 5. I am going through this list. So stop me, guys. I feel all this so important. I find that most people overbuy. when they buy a house. I did it. Most people do it. That's called buying too much house. Like I tell young people when they first get their driver's license, just because you got your driver's license don't mean you know how to drive. You just have your driver's license. You still need years of experience learning to drive. And just because you've been approved for a loan, the mortgage broker says, oh, you're approved for $500,000 loan. Go look for a house. That don't mean you can afford a $500,000 loan. They're always going to push you to the limit, the mortgage broker and the agent. Because remember, they make money and they make more money by the more you're spending. They don't care if you're going to have trouble 2 or 3 years later. Please remember that.
Say that one more time, Brian. Say it one more time.
I had this one realtor one time, this is years ago, with looking about a house, and they looked at because you approved for this, that, and the other. I couldn't make up my mind. It was in this, so it was when we were getting the townhome, Tracy. It was in this subdivision. They were like, you know what? Why don't you just buy 2 condos, one for you and one for a renter? Now I barely knew how to balance my checkbook right. And I thought about that so many times. I'm like, she sit up here, go straight up telling me, don't buy 2. Your finance is good enough to. But please understand that we pay people for their services. And I ain't got nothing against folk making a living, but folk out there for their own interests to extract their pound of flesh. You got to protect your interests. Most people overbuy. I'd recommend you underbuy. You approve for $400. Agree that you only gonna buy a $300,000 house. You'll never be in trouble. You don't want that home to own you. Most homeowners will tell you that. You get through over the many years of owning a home, and it's been like that for us. It's been up and down. It's been like torture to us because of the bad decisions and the way we bought, and it's been joy, right? But when it was torture, it was like the home owned us. It's like you just waking up every day to go to work just so you can keep the house. That's the only reason why you're working, is just so you can keep this house. I mean, that's not a good place to be, y'all. Please heed my life experience on this. We talked about fixed rate loans. You can stay out of a lot of trouble by just staying there. Fixed rate loan. Home warranties, I personally think it's a waste. And by the way, and I've had those before. I mean, most of this I've done. That's why I'm yapping my jaws. I've been down this. I personally think it's a waste. There's many reasons I could tell you why. Even if you don't have an emergency fund, it's a waste. I'm not going to break that down now. But if you're doing it right, and I said you should have an emergency fund, you don't even need a home warranty. That's what the emergency fund is for. Don't forget about the utilities. This is another one that sneaks up on people. There's a lot of upfront costs. This is one of the negatives with buying a house. A lot of upfront costs. We talked about down payment. You need the down payment. You got to bring money to the closing. And then you think about you move into the home. What are you gonna do? You're gonna outfit the home. Oh, we need furniture. Where's that credit card? We gotta need furniture. You got to pay the movers. It's a lot of upfront costs. And one of the other surprises is utilities, because we came from an apartment like a lot of people do, and typically you in less square footage. And so you're paying your utilities. Well, utilities is usually based on square footage. I mean, if you double or triple the size of where you live in, your electricity bill gonna double or triple. Your gas bill gonna double or triple. And I think a lot of people miss that, so that can sneak up on you. I got to talk about this, and I don't even know, y'all, some of you guys that own, I don't know if you've done. I am so adamant against getting HELOCs and home equity loans after you get a home. A lot of people do this, and then what they do is they improve their house. I'm going to build a pool, use it to buy a car, pay off the bill. And see, this is this is a good and bad. This is one of the beauties of owning a home. You can borrow against the equity in your house. That's one of, we talked about utility. That's one of the beauties. But I think way too many people should not be doing it. And if you're coming to me saying, Uncle B, what's your opinion? What should I do? I say stay away from it. I wouldn't do that. You want to get that house paid off sooner. That's just another bill. It ain't nothing but another credit card bill. Okay. So that's my humble opinion. And by the way, there's nothing wrong with renting. I love real estate, but in all instances, I wouldn't go run off trying to buy a home. In a lot of situations, renting is the best move. It's more than fine. It's the best move. So I'm not one of these people that think renting is for losers. I'm just, no, renting is a viable option in most instances. I mean, financially, you're better off financially many times just renting sometimes. So it's just my humble opinion of it. We talked about fix up and repair. We talked about the upfront costs. We talked about watch these realtors and brokers. Just because you qualify does not mean you can afford it. I put it in red, bold letters for people in the back of the room. And this is obvious stuff. You should be hiring a real estate lawyer to look over your contract. You get to that. And also, townhomes and condos, that's home ownership too. And they work the same way as a house, with a few exceptions. When I say work the same way, many of the same benefits, most of the same benefits, with just a few exceptions. So I wouldn't rule that out. I would look at that. I mean, I'm at the stage of my life, I'm actually looking to move back into that type of living because it's just a lot of work to own a house. I enjoyed it. I raised my kids, and I guess they got a term for that at our age. They call it downsizing. That's an older folk term. That's what we're doing. You move from the smaller dwellings to the big house to back to the smaller dwellings. So don't rule it out. Questions, thoughts, comments?
Or their experience on home
Yeah.
ownership.
Hey, I guess me and Cindy talked about our first experience of buying our home. I can go back and think we had a home for about 15 years now.
Yeah, probably.
So first thing I'm gonna say is, as Brian say, his term is that we own a home. I use the term is that I bought a mortgage.
Yeah, you own a mortgage. I say that too, Charles.
I own a mortgage, and I'm working towards home ownership. That's what I'm doing. I'm working towards getting that deed in my hand. So just to say that, but the journey for me and Cindy started out where we were renting. My mother and father had a coach house in the back, and we were living in their coach house at the time. And Cindy was very adamant about home ownership and buying a home. I wasn't really on board with it at the time. I'm like, she just talking. Go ahead and do what you're gonna do. And she came back. She went out and looked at some homes. I didn't go with her.
Well, hold on. Let me fill in because I had a friend, because you mentioned friends. I had a friend that had just gotten her license, real estate license. And so we were talking at work, and I was like, I don't know if we could really own a home, and she was like, just call. You never know what they may say. So she gave me the information to a contact at the bank, or I think she was a broker. And the woman said, oh, you're pre-approved for $250,000. So I was like, first of all, I was like shocked, because I'm like, whoa, okay. So I told Charles was like, well, just go. You can look. And so I ran with it, and I was looking, and I saw this house.
She came back home.
And I came back home. It's like, I got us a house.
I said, hold on. I said, she's very serious about this. I think I better get involved. And that's when I got involved. And I said, okay, well, we can do this, but we're not going to get this home you just looked at. We need to do some research. We need to take some type of courses of buying real estate. And that's what we did. After that, we eventually I got on board on what she wanted to do. We winded up going to a few real estate classes or courses to go about home buying.
It was a first time homeowners buying class. And they took us from like start to everything you covered, Brian. They took us through. how to
People should do that.
stay away from predatory lenders and all of that stuff. But the one thing about affordability,
Right.
that 250, I was looking for the max house,
Right.
knowing we couldn't afford
Right. And that's very
that
important.
at that time.
And I'm
you
gonna
know,
I'm gonna reiterate that too, Brian. I'm like that too. Just because they give you a $400,000, it's up to $400,000. Don't mean you have to buy a $400,000 home.
Mhm.
and Charles reeled me in quick. He was like, I'm not going over this price.
Right.
We're
What-
not doing it.
I just like you said, Brian, I want a home, but I do not want to live for it. Where I like doing other things. There's other things that I like to do.
Right.
You know, I some money, I want to save some money. You know, so what was important to me was how much is that mortgage going to be a month?
Right.
That
And
was- and to be able to see, here's another thing that people don't understand too, is that once you buy a big home and spend out, you have to, as you said, bro, you have to maintain that home.
Mhm.
Yeah.
See, you might, just like with a car, you might be afford to buy that car, but can you afford to maintain? And that's where it all comes down to, as you said, when that time comes, you something goes wrong in this house. Do you have the money to do it?
right.
You know, and just like going Isaiah, I just want to let you know, man, you know, for back between the 50s and the 60s, the average price of a house was $80,000.
Mhm.
A 29-year-old was able to buy a house. And the way our economy is and the cost of living today is, the average house is $400,000. They say it's very impossible for a 29-year-old
Don't
to
say
buy a
that.
house.
Don't
No, I'm
don't
just,
don't
I'm
say
just-
doom and gloom, because that's
no, it's not. I'm just bringing the reasons behind it, as what Brian said. It's very important not to have a lot of debt.
Mhm.
Yeah. Yeah. It can be done if you adhere
Right.
to those prerequisites. No debt, have emergency fund in place. And if you don't have debt and your credit score is good, you'll get a decent loan
Right.
and you can manage it. Even though
Right.
although these prices have appreciated, you know, the way you said, yeah.
right.
Right. And it's just, I'm just one of the people, I just got to give the honest truth about it. You know, it's tough out here today, you know. But, you know, always think about, as you were saying, Brian, too, when you do start looking for a house, have some money, because me and Cindy, when we finally got on board, it took us probably a year to buy a house.
Mhm.
So you think about, we looked at over 4 houses and we had 4 inspections that we had to pay for,
Mhm.
you know. So these things, you know, had, you know, it can be start out being very costly, you know, in the beginning,
Yeah.
you know. So, you know, eventually we did buy a house. We got a 1,400 square feet, right?
Yeah.
It's a 3-bedroom.
Yeah, we were pretty specific on what we wanted. We knew we wanted something small. Knew we wanted something at a certain price range where, you know, ideally you can pay this mortgage on one check if you need to,
Right.
you know, that kind of thing. So we were,
And another thing important for us was location, because me and Cindy both work in the Loop downtown.
yeah,
You know, me being on public transportation, I'm 40 minutes from work on public transportation. Cindy, as she works from home now, but she was driving down there, she was 20 minutes.
yeah,
So that all worked out for us. Now, we don't have kids, so we wasn't thinking about the situation. That's important too. If you got kids and you plan on bringing some kids in this world, yes, it's important to find out to move somewhere where they got a quality educational something established, you know. You know, just like, you know, me and Cindy is not people that, you know, we don't like financing a lot of stuff, you know. So, you know, with things like when you was talking about the furnace went out, we and Cindy decided that we had an old furnace. It haven't went out yet. But one thing me and Cindy did is that I didn't want no more financing. So we saved up the money and purchased our furnace.
Mhm.
Mhm.
You know, we had windows replaced. We did not finance them. What we did was 1 year, we put the front windows in.
Yeah.
The following year, we saved up, and then we did the back windows, you know. So my neighbor used to always tell me, he used to say, you know, you got a 30-year mortgage, man. And I'm just telling you from experience with him, he was saying, don't rush to do anything. Take your time.
Yeah.
You know.
But that's
so go ahead, Brian.
No, I was gonna say that's exactly, you know, how it is, you know, for the uninitiated, when you're talking about those home projects. I mean, that's a constant in your life when you own a home. You should, we got lists, we got plans, we're gonna do this year. As a matter of fact, we got the roof replaced this year. By the way, that cost me $10,000, people, let me tell you. And that was something we've been planning for not 10 years, maybe the last 5 years, saving up. And then it's always these projects that we were doing each year. We have planned for the coming years. We're budgeting for it. We're, you know, I'm just trying to, I'm just bustering what Charles is saying, that, you know, this is the responsibility of a homeowner. You know, it ain't all just look at my, and I got to go back to something you said, Charles, because it's been more than once where somebody has come visit me, someone has come to the house, and they looking at my house. They're, oh, wow, you got a big house. You got a nice house. And you know what I always say? I got a big mortgage. I ain't got no big house. I got a big mortgage.
Right. You know, so what I'm saying is just don't live over your means. Mm-hmm. That's all I'm saying, man. You know, be comfortable in what you do when you do decide, you know, new homeowners buying a home. You know, because one thing, like we said, you got to maintain that big home. You know, the bigger the house, the more the gas bill, the more electric bill, the more property you got, the more grass you got to cut, you know. So that's the most important thing, you know. Just don't try to live over your means, and don't want to have to live for a house, you know.
Yeah, I want to ask Greg, because I know Greg's owned his home forever, down there in the dirty South ATL. Greg, what's your take, man? Being a homeowner for all these years.
Dirty South, huh? That's what we call it down here. Yeah, right. This is very good information. I moved down here, I think it was either 1995 or 96. And when I first moved here, I, of course, rented until I got more familiar with the area. And then I bought my house in 1997, brand new. And the first mortgage that I had on my house was an adjustable mortgage, just to get into the house. I did meet the 2836 rule, but what I had was an adjustable mortgage, which also had was called a 2-1 buy down. So the builder bought the rate down, or the mortgage company that the builder was using bought the rate down like 2%. And then after that, after I got more of a comfort level and started making more money, I refinanced and got into a fixed rate mortgage. Now, my recommendation to you guys is, for those of you who don't have a house or are thinking about buying one, I've refinanced my house 3 times, and I've gotten a better interest rate 3 times. But I never refinanced it back to the 30-year mortgage. I've always refinanced it with fewer number of years to pay the loan off. And the reason why that I did that is because I like where I live. And I'm not going to say I'm not going to ever move from here, but I was the type of person that I didn't want to be paying on a mortgage for my entire life. Because all of us are going to get to an age where we're going to start working, we're going to retire, we're going to be on kind of a fixed income unless you continue to work, you know, and you've got a business or whatever the case may be, where you may not be making as much money as you're making now. Okay. So I always reduced the number of years that I financed it. And another thing I wanted to bring up was that I live in a subdivision that has homeowners associations fees that you have to pay yearly. Okay, I'm not sure if anybody else on the call is in one of those type of communities, but you got to pay that. Now, mine in particular is like, I think it went up to $520 per year, which is not really a whole lot of money. over the course of a year, but that is part of the expense of buying homeowners. And the reason why, just in case you guys don't know why some subdivisions have homeowners associations, because they really get on the people that live in the subdivisions to keep their property up, so their property values can stay up. And some people don't like to be in a subdivision. They got homeowners association. They don't want that extra expense for whatever reason, because that price can fluctuate as well. It can go up, which is what most things do. They go up, over time, or they can go down. Like ours went down one time since I lived here, and that was during the COVID crisis. And that's because we wasn't using the facilities. I got to swim. I'm in a swim tennis community. So since when nobody using it, they lowered our homeowners association costs. And another thing I want to bring up is that when you're making a decision to buy a home, once you get a certain age, and I'm not sure if this varies from state to state, but you can apply for what's called an exemption and have your property taxes reduced.
They have that in Illinois. Yep.
Okay. What they'll reduce is the biggest part of your property tax, and that's the taxes that you pay for schools. Okay. That's going to make an impact on your mortgage payment as well in terms of lowering it. They also have it where you can apply for an exemption if you become, for whatever reason, disabled. You can get a reduction in your property taxes for that as well. Okay, but just like Brother Charles was saying, I'm glad that I bought a home. I found a subdivision that I still feel safe in. I can go to the store without my door locked, and I really don't worry about somebody just walking in and taking anything. I think you guys all know Georgia's booming big time. We have so many subdivisions being built right now. It's just off the chain what's going on in Georgia right now. So, the house prices consequently has gone up. There's thousands of people from Chicago that's moved here, thousands from DC, thousands from New York, thousands from California. They're coming down here buying these houses cash because relative to where they live now, these prices are still cheap to them and things of that nature. So like my brother Charles and Ray was saying, the biggest thing is to have you an emergency fund, because I guarantee you things are going to break. They are going to break. Your water heater, your furnace, your air conditioner, you're going to have leaks. If something is going to go wrong. So as long as you got money put aside for that purpose, you'll be fine.
Thank you, Greg. Thank you. Anyone else? Any questions? There are, if no questions, we're near the top of the hour. There are just two things I wanted to see if we can get to before we close out. For those who can hold on, if anybody got to drop, I understand that. I want to talk a little bit about, just look at homeownership as a wealth building tool, to really hone in on the financial part of it. And I really want the young people on this call and those who will view it to understand this part. We talked about the intrinsic value, that sense of ownership and privacy, all that sort of good stuff, and talked about, the steps to get there, what it's like owning it. But let's just focus on simply the financial part. This is one of the biggest reasons why most people want to get a home. And also, as you all know, that our next meeting on real estate, this was just about buying a home, becoming a homeowner. The next one is on real estate investing. And it made sense. We had talked about this. It makes sense to do this first because a lot of the mechanics of real estate investing is just in knowing how to buy a home, and then the rest, real estate investing is a business. So you need to know how the numbers work. But I just want to show you this one graphic I put together so you can see the impact of homeowners, why so many people are in real estate, why most wealthy people own homes, own multiple homes. So one, some of you know this, some will not. I'm going to give you the lay of the land here. we're going to take the example of buying a $300,000 house, right? And I really want to focus on equity. So equity is the amount that you've paid down in your loan plus the appreciation minus what you still owe in the loan. That's your equity. So in year one or year zero, whatever you want to call it, if you buy a $300,000 home, you owe $300,000. You got zero equity. Okay. Now I'm going to jump at 5-year intervals. I'm not going to take us out 30 years. And this is typical. This is a hypothetical example. Of course, if you're buying in the wrong neighborhoods, these numbers ain't going to work like this. But assuming you're buying in the right neighborhood, you can see the assumption over here. We're going to run it out 30 years. One thing about buying a home is an asset. And all I mean by asset is the value of it appreciates. It goes up in value. Unlike if you go buy a car, the value of that car is going to zero after 5 years or 10 years or whatever. A home, like a stock, a bond, or something's asset, it's going up in value, the value of it, the value that somebody wants to pay for it. So in year zero, you bought it for $300, you got a loan for $300. Soon you put nothing down. You got a loan for $300. You owe $300,000 in year one, brother. You got zero equity. You ain't paying nothing down. It hasn't appreciated yet. You still owe the entire balance. After the first 5 years, this lighter green is how much you paid it down. And I ran these numbers using actual numbers. This is hypothetical, but I used the actual numbers in a calculator, some of the 3.5% appreciation rate. So after 5 years, on average, the value of the house would have increased $56,305. You would have paid it down $17,000. These two together is now your equity. This is your equity. And I'm just going to pause. Say equity is a real thing. A lot of times people just hear these terms and don't know what they mean. That means if I sold this house after 5 years and made it to the closing table, I, as the seller of this house that I bought 5 years ago, would be getting $74,260 cut to me in the form of a check. This is the power of real estate. And by the way, I use 3.5% appreciation rate. If you Google it and look it up right now, they're going to say on average, most homes in the US, they're going to show you, say 4% or 4.5%. I'm being conservative. So let's look what happens in the next 10 years. We're paying. We're not missing a payment. We're not defaulting. We're in a good neighborhood. We're getting that 3.5% on average. Some years it's going to be down, but some years up more. On average, 3.5%. With the 10-year period, you've been paying for 10 years. You've now paid off you paid off an additional $25,000. This is year by year over this 5-year period from here to here. And the value of your home increased an additional $66,874. So if you add where you were at 5 years, this was your equity. You've paid it down an additional 25. It's appreciated an additional 66. The value of your equity is this amount. You can borrow against it. You can sell it and cash out, take the check. Okay. We're at year 10. Let's go to year 15. Let's move this along. I think you guys are starting to see the pattern. Again, you notice the red, you started with a $300,000 loan. Obviously, the loan is going down over time. You're paying it down. You're paying it down 15 years in. As the years go on, you pay more and more down each year, right? So from year 10 to year 15, you can add this $35,000 additional that you paid down to the 166. Oh, over this last 5-year period, it appreciated another $79,000. Now this is your total equity. This is yours. This is real money. Okay. You can see this is a powerful tool in your wealth building, in your overall portfolio, in increasing your net worth. Matter of fact, if you just look at it like this, assume you had no 401k, no stocks, no bond. All you ever did in life was buy this one house for $300,000. In year one, you had zero net worth, because your net worth is assets minus liabilities. And your net worth is slowly growing. And what I like about the house is that you don't think about it. That's why a lot of people call a house a savings account, a piggy bank. You're just paying your mortgage every month. And this is what's happening. It's unconscious. You don't even think about it. And so we played this out. The example is hypothetical, but the numbers are real. Year 20, you've made it to year 20, right? Now you're paying off more. Every 5 years, you pay off more and more and more because you got less balance left. Look how much your home appreciated over the last 5 years from year 15 to year 20. This is your equity. Now, I know I got your attention now. I know I got your attention. Okay. Let's go to year 25. I don't have to explain it anymore. You've almost got the house paid off. You're getting equity from how much you're paying off over the years and how much the value of your home, the market price, is appreciating. Right? And then when you finally get to year 30, assuming you never refinance, as Greg was describing, you just got your loan and you paid it, you didn't miss anything, you paid it off after 30 years. You started off with a $300,000 asset. You have $842,000 in equity. That's the value of your home. Yes, homes do double over time, over this period of time. You know, when I first started in my home, most people just want to get a home, live in it, raise their kids. But when I started to understand all the tax benefits, by the way, I'm not even telling you about the tax benefits. I'm just showing you the effect of paying down your loan and appreciation over time. And like what Greg said is, what he does is when he refinanced, he cut his 30-year loan down, which is what a lot of people do. A lot of people try to get this done within 10 or 15 years. How do they do that? They send in extra payments, which takes off years off the house. So they can hurry up and get this done and own their house free and clear, where they don't own the bank, nothing. The whole market value of the house is theirs. But see, this is another reason why I say I wouldn't get a HELOC and all that sort of stuff, because again, you adding time on to paying it off. And like Greg said, if you do refi, the whole loan, which is a good thing, when you refi, you should be lowering your payment and or cutting back on the years so you can hurry up and get this over. But I just want you guys to visualize this, particularly younger people just starting off, people who buying their first house. This is the power of real estate home ownership. And this is going to lead us into real estate investing, because people basically understand this and they take this picture and they parlay it out into more wealth. Just think, if you had 5 homes, you could stop after year 15 and you would have over $1 million in equity, which people do. And they just sell all the 5 homes, pay off that little small balance, and they got over $1 million in equity. Heck, they got a renter paying the payment. It's fine, long as the numbers add up and the renter can cover that payment stuff we were showing, let them pay all of that. And then they decide, okay, I'm ready to cash out. I want to go live in wherever, Bermuda, leave the country and take it. So I just want to show that very quickly. I got one final thing, and then I'm going to let you all go, those who are still hanging on. Any questions here? Okay. One final thing. I promised, let me see what we have here. Jeopardy. We're going to do some Homeowner Jeopardy. This is Homeowner Jeopardy. That's what we're going to close out with here. Let me see if I can find. Here we go. Y'all ready? You can come off mute if you're on mute. We're going to do this together. We can break this up as teams, but we're going to do this together. So the categories are pros and cons, the process, part 1, the process, part 2, acronyms, buying and closing. All right, let me wake somebody up. Come on, Melissa. What do you want? What category and what amount? Come on.
Let's see. I will do the process part 2 for 100.
Process part 2 for 100. What is it called when lenders want your maximum housing payment to be no more than blank of your gross monthly pay and no more than blank % of your total debt service, which includes housing and other debt, such as car loans and credit cards? What do we call that?
2836, 25 for an Uncle B.
Yeah, close enough. What is the 2836 rule? Oh, man, add that in there. Okay.
Job, Melissa.
All right. Who up next? Is Isaiah still out there? Come on, let me hear from somebody who ain't. What category? Cindy Charles? Come on, y'all better know everyone on this board.
Pros and cons. What you want?
Pros and cons.
How much?
400.
400.
Pros and cons for 400.
Oh, he said.
No. Okay, well, can it increase your credit score? Yes.
What, I need it in the form of a question. What can increase your credit score?
Purchase of a house, right?
Yeah.
Yeah.
What can owning a home do for your credit score? All right. All right. Let's get a couple more here. Greg, what you got?
400.
Oh,
Let's do, let's see here. I can't see all the top of them. What's next to pros and cons? Oh, part one and part two, my bad. Let's just do buying and closing for 300.
Buying and closing for 300. Schools, attached garage, shopping, crime rate, fish jar.
Schools, attached garage, shopping, crime rate.
No.
Man, you got me on that one.
All right. What are your house hunting preferences?
Oh, okay. Okay.
Who else want to try? Tracy, you want to pick one?
Okay, I'll do the process part 1 for 100.
Process part 1 for 100. Debt free.
What you should be before you look for a house.
What you should be before trying to purchase a home. Ding, ding, ding. Anybody else?
Acronyms for 500.
Which one?
Acronyms for 500.
Acronyms for 500.
Brad Payton.
Yeah. HUD. 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 This is a tough one because we didn't spend really any time on this. This is actually a tough one. Okay.
Googling it.
What is housing and urban development?
You Googling it. What is housing and urban development? Okay.
Is that Isaiah Payton?
That was Payton. Anyone else? Anyone else think they master of Jeopardy homeowner? Anyone else? Let me try one. I'm gonna try acronyms for 100. PMI. I better know this. I put together the daggone thing. Private mortgage. What is private mortgage insurance? See, I almost missed it because I didn't. That's when if you don't put at least 20% down, they charge you this fee based on what you put down.
And it protects the lender, not you.
Anyone else?
Let's do pros and cons for 100.
Pros and cons for 100. Answer is homeowners pay these utilities when they own a home.
All of them.
Homeowners pays these utilities when they gas and light and water.
Come again, Greg. I'm gonna give you one more try. Otherwise, I'm gonna have to go to the judges. Yes. You know what?
Yeah.
I'm gonna give it to you. What is you pay all of them?
Oh, okay.
So there you go.
Pros and cons 200.
Pros and cons 200. Happiness, freedom, privacy, control, accomplishment.
What are the pros of owning a house?
Let's do that. Intrinsic value.
Okay. What are some of the intrinsic values of it? Your mommy says I have to give it to you.
Give it to him.
I would give that to him.
Process part 2.
The process part 2 for how much?
300.
300. 500 credit score is okay, but you'll have to put up more of a down payment.
what is the FHA loan?
What credit
Oh,
score
nice.
FHA allow you? That's important because normally it's 620. Good job, Cindy. But if allow you, FHA allow you to go down to 500.
Cindy, you were paying attention.
Oops. Oh, I accidentally selected that. Okay, who can answer it?
Which category is it? Oh, buying and closing for 400. Okay. 5 to 6%.
Come on, this one's easy, y'all. The
amount you have to have.
For what? I'll take it. What's the amount you have to have for what?
Down payment? No.
What is the typical commission paid to the real estate agent?
Down payment.
All right.
2% unless, you know. Okay.
All right. Let's keep it going. Any more?
Process part 1 for 500.
All right. 620.
Credit score.
I heard a credit score from Tracy. Let's see. What is the minimum FICO credit score?
All right.
Nicely done. I'm gonna pick one here. The process part 1 for 300. 5 to 7 years. I'm gonna give y'all a tip. This was a Uncle B preference.
The amount of years minimum amount of years you should stay in the home when you first buy.
Nice.
What is the minimum time? Yep.
All right.
Who wants in?
Buying and closing 100.
Buying and closing 100. Home inspection and appraisal.
What you have to have done when
Before you close.
close on the house. Before you close.
I'm gonna take it. I specifically said after the seller accepts your offer, but that is before you close. So we'll take it. All right, come on, y'all. We got to clear this board now. We didn't come too far. Acronyms 200. LTV. We didn't talk about this much in the presentation.
LTV.
Long-term value of the home. All right.
Okay, y'all, one more try.
LTV is LTV.
Loan? What is loan to value?
Loan to value. I said it wrong.
Who's up? It's got a few.
Pros and cons 500.
Pros and cons 500. More control over your housing budget.
Oh, that's owning a home. That's a pro.
It's a pro of owning home.
What does the ability to refinance your home loan give you? I'm gonna have to reject that one technically, y'all.
That's our answer for everything on that column. It's a pro.
Okay, we got 10 spots left. We got to finish this. I had a feeling who's ever watching this later gonna want to see all these answers revealed. All right. The process part 2 for 500. Pre-approved.
You should be pre-approved before you start looking for a home.
Tracy said you should be pre-approved before you start looking for a home. What is something you should be starting your search with a real estate agent? So what is something you should be starting your, okay, I didn't articulate that properly. What you said is correct, Tracy. There we go. Let's clear out pros and cons for 300. Closing fees, moving fees, furniture, painting. A lot in the beginning.
A lot of what are upfront costs?
It's y'all.
Nice.
Woo-hoo-hoo. It did.
What an upfront cost.
Yes, it did.
I'm gonna take buying and closing for 500. Real estate agent.
Make sure you have a good one.
Take that too. Make sure you have a good one. Make sure you have one when you start the search process.
The home search process.
Guide you the time. Okay. Let's wrap these. Let's finish process part 1 for 200. Emergency fund.
What you need for unexpected repairs.
Yeah. And what else can we say about it?
And you should have one before searching for a home.
Yeah. All right. Process part 1 for 400 to close that category. 3.5%. Why was that meaningful?
That is that the amount of the down payment? No.
The minimum amount of down payment you should.
Oh, okay. Okay.
Killing it, Cindy, killing it.
Cindy, you give me an impression that you and Charles stumbled into that home of y'all's. All right. Process part 2. Let's wrap up this. If you get paid twice a month, it is half of one check and no more.
Your mortgage payment.
Yeah, there's a name for it. Remember the name for it? Uncle B's. Just gave you a tip.
Rules?
Uncle B's 25% rule.
Uncle B's.
All right. 400 to close out. Process part 2. Conventional. FHA, VA, jumbo.
Types of loans. What are types of loans?
There we go. Going in acronyms for 300. VA.
Veterans loan.
Veterans Administration. Yep, loan for the veterans. We'll take it. Acronyms for 400. PITI.
Property interest, taxes, insurance. No. Yeah, payment, interest, taxes, insurance.
Payment, interest, taxes, insurance.
Did I say payment, interest, taxes, and insurance? I'm missing. What's the first one?
Principal, interest, taxes, and insurance.
Principal.
There you go. I couldn't rightfully give a bunch of homeowners the points for that. You got that wrong. All right. And to close out the board, buying and closing for 200. Closing costs.
The amount you should have when
What is the something you have to pay at closing? Something closing cost. There you go.
I think Peyton had a question.
Yes, go ahead, Peyton. Close us out.
Yes. I wanted to go back. First of all, thanks for this. I really appreciate this. I wanted to go back to what you were talking about earlier about renting. I know renting is a good thing, but is it, especially if you're living like, when you see $600,000 homes or, these high cost of living areas, is it okay to rent for 5, 6, 7 years? Like, how quickly should someone be moving to a house? Like, how quickly should that process be? Like, what typically is the range? I just want to get you.
Let me go first, and I'm going to give it to the other homeowners because we might be in different places on this. I'd be interested in what you have to say. One, I know in your instance particular, and you just moved to an area. We didn't talk about that, but that's another bit of advice I'd give people. When you first move to a town or a place, I wouldn't even think about buying the first year or two, particularly if you're completely new to that state or something like that. I would get to know areas well before I even think about settling. And then I think what your concern is the increasing cost of homes and that sort of thing. For me, I just wouldn't let that faze me. I would think more about the steps we had here. Have I saved up? My credit score right? Do I have the emergency fund? Am I getting the right area, the right house? It won't be that long. I just think people make bad decisions when I gotta buy it, because if I don't buy now, they're going to be more, next year. Housing prices always come back down. They're like anything else. They go up over time, but you're going to find windows where, they've depreciated some of the prices will come back. You'll find an area at a price with the type of home that you like is going to be there. Or they're going to come up with new mortgage programs to make it more affordable. So that's just my take. I wouldn't let the pressures of what's happening in the market force me to buy before I'm ready. Be interested in what others have to say.
I would agree with that. I wouldn't let that determine when and where I'm gonna buy either. The pressure of trying to buy something now, thinking that the home that you want may go up. The most important thing is to make sure that like Ray was saying, you have good credit, you have the money that it takes to put down, live within your means. That's essential. Don't buy too much house because as you progress in your career, Peyton, typically people make more and more money as they age and get promotions and get other jobs and things of that nature. So I agree with that. Don't be phased in trying to rush into anything because my experience in life is when you rush into something, you typically make a bad decision that you regret. So you need to feel comfortable about it and do your homework, ask for guidance. You get a lot of guidance here on this call that you can go to as a resource. You're going to meet people that can give you some good advice over the course of your life. So just utilize your resources and keep doing what you're doing. It'll work out. Because one thing we can't predict is what's going to happen tomorrow in the world and in the economy. We never know what life event is coming up that may happen to where the housing, like in 2008, we had a big housing crash. But I'm sure the elderly people on here remember that when they were practically giving houses away to people at, they was talking about what the word they used was predatory lending when they wasn't really even verifying people's income that were buying these houses. And then they got in trouble. They bought too much house, and then when they had to start paying for them, they just lost them all. So definitely, when you're making big decisions in life, take your time. Okay, take your time when you're making big decisions. And in my opinion, a house is a big decision.
I would agree with everything that Greg says, and Brian. Take your time because if Charles hadn't reined me, reeled me in, it would have been a bad decision because I was trying to rush the process. And so when Greg says take your time, don't live beyond your means, just really think about that. Just prepare yourself, educate yourself before making that long-term purchase and decide where you want to settle. Because right now you're in a new space, you're in California, but you never know if with the flexibility of your job, you may want to move and settle to another, a completely different state or something like that. So just take your time.
Right. You got time, baby.
Yeah.
Give yourself about 5 years, man. Save some money.
And I would, suggest that to both of you guys, you and Isaiah, just take your time before you make those big purchases and decisions.
As he said, if you got some debt, work on getting that debt down.
Yeah.
I know y'all can probably got student loans and things like that. And, if you can work on getting that debt down, but right now, get yourself settled where you at first. Cause like Cindy said, you might not decide to settle in San Francisco. You might decide to relocate, where maybe you might decide to move somewhere where the cost of living is much cheaper, but just give yourself some time first,
And I would just add that one thing that Dad said in the presentation, it's okay to rent. It is okay to rent. I mean, some people rush to buy a house and every month later on their rent. I mean, if you can't manage the things that come with renting, then I don't think there's any way you could manage a house and all that responsibility. So it's okay to rent and make sure you're taking care of even the rental. You still have to take care of it. So I think it just prepares you for the house.
Yeah.
For home ownership.
Right.
Yeah.
Get the experience. You know, like you said, it's okay to rent. I mean, we rented for years before we decided to purchase a home, you know. So I mean, we purchased our home to what? We were both without late 30s. You know, so it's okay.
Absolutely.
Yeah. And I promise you, Peyton, and all those who are waiting, you're not going to miss out. Trust me, you're not going to be, people will always be able to buy a house. I know it seems like these prices are way high. Trust me, particularly someone like you, who I know is disciplined at a young age financially. You're not going to miss out. When you're ready, it's going to be available to you, and you're going to be able to get a nice one in a nice area that, you know, you and your wife are happy with. So that I can promise you.
Absolutely. Charles and I used to look at this station that came on. Do you remember this? They used to show housing prices, houses in Chicago. And it was just like some real estate station. And at the time, the houses in Chicago were like $80,000.
Yeah.
And we would look at it and be like, there's no way, you know, how can we afford that? You know, at the time, I didn't think it was even attainable. So don't think, you know, you see the prices now, you will get your home when it's time for you, you two to get your home, you will get your home. So don't be discouraged by the prices.
What goes up must come down.
Yeah, just be ready when it does come down.
Right.
That's what you want to do. Just be ready when it comes down, because you're right, it is cyclical, and it's always going to be that way.
All right.
Thank you.
Okay. Anything else? We're over. It's been about an hour and a half. We probably should go ahead, shut it.
Yeah, because Tracy got to watch the All-Star game.
I know.
Yes, I do.
Last one, and I'm done. Next meeting should be on real estate investing, real estate as an investment. And then I'm really excited after that one because Greg has a financial planner that he's worked with who's offered to come talk to us and allow us to ask questions. Cool. And that's something I always wanted this group to evolve. I mean, eventually we'll come back to real estate and stuff. We'll have a real estate agent on here, a broker, answering questions. So, you know, we'll be hitting them. So I'm really looking forward to that. So we'll get the real estate investing in, and then I'm gonna work with Greg to get him scheduled. And so look forward to that. And I'm gonna ask everybody let's get our questions together beforehand. We'll be ready and pepper them, and I'll try to facilitate and make sure all these questions are getting answered. So look forward to that. I'm excited for that.
Cool.
Yeah, sounds good.
All right.
Until next time.
Until next time. Thanks all. Great meeting.
All right. Take care.
Bye-bye.
Everybody take care.
All right.